You've probably seen the headlines shouting that the child tax credit jumped to $2,200 per child. But if you're expecting a crisp check for that exact amount to just show up in your mailbox, you need to look closer. Most parents won't see it happen that way. Welcome to Easynance. We take confusing financial headlines and translate them into plain English. Today, we're cutting through the noise on the child tax credit to show you exactly how the income limits, refundable catches, and disqualifying rules actually work. Here's the good news. Under the new One Big Beautiful Bill Act, the credit was raised to $2,200 for qualifying kids under 17. Even better, that number is locked in permanently, meaning it won't drop back down to $1,000 like the old law dictated. And starting in 2026, this chart shows how it actually adjusts upward for inflation. So the $2,200 headline is real, and it is permanent. But accessing that money depends on specific IRS mechanics that determine who actually qualifies. To understand how this works, we have to clear up 3 terms people mix up all the time. A tax deduction lowers the income you get taxed on. A tax credit lowers your actual tax bill, dollar for dollar. And a check is just cash sent directly to you. The main portion of the child tax credit is a non-refundable credit. That means it wipes out the taxes you owe the government, but it cannot lower your tax bill below 0. Let's look at a family we'll call the Johnsons. They're a married couple earning around $80,000 a year with 2 kids. They owe enough in federal income tax to use the full benefit. At $2,200 per child, those 2 kids equal a $4,400 credit. Because the Johnsons owe at least that much in taxes, that entire $4,400 is wiped completely off their owed balance. For middle-class families with standard tax liabilities, this functions as a massive dollar-for-dollar offset. But notice the catch. This structure leaves out lower-income earners who don't owe thousands in federal taxes to begin with. To help families who don't owe enough tax to use the full credit, there is a second piece, the additional child tax credit. This is the refundable catch, the money you can actually get back as a physical refund check. The refundable portion is strictly capped at $1,700 per child, not $2,200. Furthermore, you must clear a $2,500 earned income floor and wages to trigger the 15% refund calculation. Unemployment or Social Security do not count. Take Maria, a single mom with 1 child, earning about $20,000 a year. Her refund is calculated as 15% of her earned income above that $2,500 floor. Because her calculation easily clears the cap, she scores the maximum $1,700 refund check. Compare that to a family earning under $2,500 in total wages for the year. They fall below the floor and receive a $0 refundable credit. Because the math is designed to reward earned income, the absolute lowest earning families are paradoxically locked out of the cash benefit entirely. On the opposite end of the spectrum, we have the ceiling. What happens to families making too much money? Permanent limits phase out the credit based on modified adjusted gross income, over $200,000 for single filers, or $400,000 for married couples. It's a gradual slope, shrinking $50 for every $1,000 earned over that limit. Let's look at David, a single father with 1 child, earning $230,000. He is $30,000 over his limit. That creates a $1,500 reduction, leaving him with a partial credit of $700. Earning over the limit puts you on a gradual slope, not a cliff. High earners should not assume they are fully disqualified from receiving a partial benefit. Even if the math works in your favor, there are strict administrative rules you have to pass. First is the Social Security number requirement. At least 1 filing parent and the child must possess a work-eligible SSN. This completely disqualifies families filing exclusively with ITINs. Then there is the hard age boundary. The child must be strictly under 17 at the very end of the tax year. Consider the Patels. Their dependent child just turned 17 in December. Because of that birth date, they age out of the $2,200 headline credit. The fallback option for the Patels is much smaller. They can claim the non-refundable $500 IRA credit for dependents instead. Understanding the complex financial math means nothing if your family runs afoul of those hard age and citizenship requirements. If you meet all the criteria, the final step is actually claiming the money. That means dealing with the IRS. You'll need to use Form 1040 and attach Schedule 8812. That's where you'll figure out which category you fall into, whether you're offsetting taxes like the Johnsons, claiming a refund like Maria, or calculating a phase-out like David. Make sure to keep meticulous records of your dependents. Do the actual math on your tax return rather than guessing your eligibility based on a new snippet. And remember, this video provides general educational information, not official tax advice. Every family situation is unique, so verify your specific details at irs.gov or with a tax professional. Knowing these nuanced rules turns a flashy headline into a practical strategy that keeps real money in your pocket. For more clear translations of the financial world, hit that subscribe button. Thanks for watching Easynance, and we'll see you next time.